everyone, hey, it's Mrs. B. I am here and I am going to take the practice exam. So I would love it if you would take it with me. So if you are going to take it with me, I have all the problems. So what you could do to really help yourself is have an Excel spreadsheet open. And I am going to so what I've done is I copied all the questions over in an Excel spreadsheet and I'm going to work them. So you can really benefit yourself by having some of these worksheets already set up. It's going to save you time versus having to set up the format for a trial balance or a balance sheet or an income statement. And also I would encourage you to forget what chapter it is, but I know you guys are smart, you can figure it out. I want to say 12, but I could be really wrong. But find the chapter that's got all the ratios in it, current ratio, acid test, all of those, and have an Excel spreadsheet set up with all those formulas. So you do not have to hunt back, you just know. So you just drop these numbers in and boom, you're done. Because this test, if you've done the homework, you know what that is. You've got a good grasp of the information, but it's a lot of problems, okay? There are very few vocabulary, a lot of problems, and you're going to need every minute, okay? Unless you're just super, know this like the back of your hand, that's great. But still, just the whole setting up of problems and such can be time consuming. So go through, answer every question you know. Boom, 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 got this, easy, not sure, go on to the next one. And then go back and finish the difficult ones, okay? The ones that you had to really think about, and studies show that your first impulse is more often correct. I mean, you may okay, that's A, that's B, it's well, so on and so forth, and you may see something on problem 15 that strikes something in your brain to go, oh, that's right, that's why problem 2 is not correct, and you go back and change it. But for the most part, your first impression is the correct one. So just good strategy. So answer all the questions that you know first, and then go back and finish the ones that you don't know. And especially if you can have an Excel spreadsheet set up. So if you do not have two screens at this point in your life, you are just really causing yourself extra work. And two screens are very efficient. I actually have 4. But anyway, because I am constantly using all 4 of my screens with all my things that I have open as I grade, as I research, whatever. So, but you got to at least need 2. So you can have one for the problem and one for your Excel spreadsheet. So, all right, I hope that's helpful. So let's get started. Let's take this exam. So here we go. So there's that one. So let's get rid of that. All right, here we go. So I'm hoping you can read that, and hopefully it comes through on your screen. So these 2 problems are very similar. They're just asking different questions. So let's just work through them. Okay, so here's my strategy when I take the exam. So as I'm reading this, I am typing the information over here, okay? Alpaca Corporation had revenues of $260,000. Boom, revenue, $260,000 right there. It's first year of operations, okay? That's important. Okay, first year of operations, that's important, okay? The company had not collected $19,100 of its sales. Okay, so what does that mean? Made a sale, so we're going to credit sales. What do we debit? We debit accounts receivable. Okay, that's the other half of that sales transaction when it's on account. So accounts receivable, $19,100. And it still owes $27,200. So if you owe something, on merchandise purchased, okay, that sounds like accounts payable. Accounts payable, $27,200. On $97,000 of merchandise purchased. So purchases, $97,000. Okay. The company had no inventory on hand at the time of the year. Okay. Beginning inventory ending inventory is 0, and beginning inventory is 0 because this is its first year of operations. The company paid $12,900 in salaries. Okay. The owners invested $15,000. Okay. The business and borrowed $15,000 in a 5-year note. So notes payable, okay. The company paid $4,000 in interest, so interest expense, and the company paid $8,000 for a 2-year policy. 2 years, keep that in mind. 2 years, don't let that mess you up, okay. On the first day of business in Alpaca had an effective income tax of 38%, okay. So assume no other taxes are paid in the same year. So I have all that information there. So all I can do is then I can just go, actually I was bad anyway, so then you can just grab that information, and then if you have a similar problem, all you have to do is change these numbers and it will flow through. Okay, see how I did? So I'm going to go, all right, so before I start working the problem, what's the question? Compute the cash balance at the end of the first year for Alpaca Corporation. So it's the end of the first year, so beginning balance is 0, okay? So beginning cash is 0, so we have to worry about that. It's not second year, right? So what's the ending cash balance, all right? So we have sales less accounts receivable. So I'm just going to go up and grab that, okay? And that's going to give me, okay, so that's going to give me 260 minus 19.1, so that's going to give me the cash received from the sales, okay, because I'm worried about cash, right? So, yeah, this might be, because we really haven't dealt with the cash flow statement all that much, so this might be a little overwhelming, but it's really not that difficult. You just got to think through it logically, and we're just trying to figure out the cash, with cash in, cash out, okay? So we have, so what is this? This is the $249,900 is the cash we've received from the $260,000 in sales. We still have $19,100 available, okay? And then owner investment, that's an influx of cash of 15, right? So let's go get that, okay? 15, and then we have notes payable, so, or bank loan payable, whatever you want to call it. I'm just going to call it notes payable. So, so this is total receipts, right? So we have cash from sales plus investment plus a bank loan. So we have $270,900 cash rolling in the door, okay? So now we have cash disbursements. So we have purchases of $97,000, but we owe, what do we owe? Accounts payable, $27,200. So we owe 69, so we have paid, so we owe $27,200. So we've paid $69,800 of our purchases, but we still owe $27,200, okay? So $69,800 went out the door. And then we had $12,900 in salaries, okay? And then $4,000 in interest expense, and $8,000 in our insurance policy. That's cash out the door. We're not we're going to see when on the next problem that it's got an insurance. We do have a timing issue because we're calculating income, but on this one we're just calculating cash. Okay, so that was $8,000 out the door, and then we have to estimate income taxes paid. So, so this problem did not give you any extraneous information. You need all the information in this particular problem. So how did I get that 53,998? So I took 260 minus 97 minus 12,900 minus 4,000. Hold on, I'm thinking. It's also minus the 8,000. Okay. Oh, minus 4 of this 8. Okay, half of this, and so I don't have a subtotal, but whatever that is times 38% is 53,998 is what I owe in taxes. Okay. So that's out the door, okay? So when I take all my cash disbursements, what I paid in my purchases, plus salaries, plus interest, plus all the insurance, because we're talking cash out the door, not what we expensed this year, estimated taxes, and total cash disbursements is $148,698, and the ending cash balance is $122,202. So that is the answer the problem is looking for. So I will highlight that in yellow. Okay. All right. So now we have a similar problem, but this one wants us to compute the net income. Okay. So got the same issue. All right. Trifecta had a partnership, and again this year. So here's all my numbers. Okay. So we have revenue of $365. Okay, of the first year of operations, and this year is not so important because we're not dealing with beginning cash. Okay, the partnership had not collected 46,900 of the sales. Okay, so we had 365,000 of sales, but so we have accounts receivable of 46,900, And we still owe $38,500 in accounts payable on our purchases of $175,000. There was no inventory on hand at the end of the year. The partnership paid $29,000 in salaries. They invested $48,000 in the business. That's equity. And the business borrowed $25,000 on a 5-year note. The partnership paid $27,500 in interest, and the amount owed was and paid $8,200 for a 2-year policy. Okay, so compute net income. All right. So revenue minus purchases minus salaries minus interest expense and minus half the insurance gets us to net income of $154,150. Okay. So again, you're just gonna, I started, basically I copied everything over. I copied this over, and then I just got rid of everything that didn't belong on the income statement, since I knew I was gonna calculate the income statement. So, all right, let's move on. Okay, and so if you have any questions, reach out and email, and I will be happy to answer your questions. And if it's pertinent, maybe I'll just throw it out to the whole class. Now, this is one of those problems where there are 3 different problems with the same. It could ask you maybe more, but in my practice set, I got this problem 3 times. So instead of putting it out there 3 times, I just thought I'll just kind of show you how to work based on what it's asking, how to work this problem. So we have net sales, total assets, end of year cash balance, stockholders' equity, gross profit, which is sales minus cost of goods sold, increase in cash for the year, operating expenses, net operating cash flow, and other income or expense. Okay, so sort of a mishmash, hodgepodge of information. So what does it want to know? So the first thing it wants to know is cost of goods sold for the year. So, as I was trying to, so basically I copied this all over, and then I started getting rid of everything I needed, and then it was like, duh. So, net sales minus gross profit, what's the difference is cost of goods sold. So this is disgustingly easy. It's very simple. So, depending on what it's asking, there's a lot of information here you do not need, right? So if it's asking for cost of goods sold, we just need net sales minus gross profit, and the difference is, so $10,725 minus $25,999 is a difference of cost of goods sold of $81,26. All right, but what if it asks you for income before income taxes, earnings before income taxes, or income before income taxes, however it's called? So basically, then we're going to take our gross profit less our expenses, okay? And the tricky thing here is you've got this negative number. So how do you deal with that? So we have cost. So we have gross profit $25.99. We have operating expenses of $20.58, and then we have negative 23. So you could either do it. You could take $25.99 minus $20.58 plus the negative 23, which gives you $5.18, or you could just take the negative off and go $25.99 minus $25.58 minus 23 gets you $5.18, same number. Okay, that minus is there to confuse you, to think, it's getting you to think through adding, subtracting, negative, positive numbers. So, all right, what if it wants to know the beginning cash balance? Okay, so we're going to take the end of the year, so that the cash information that we have over here. So we have end of the year cash balance, and we have increase in cash for the year. So those are the 2 cash things we have. So end of the year cash balance is $10.95, and we have net increase in cash for the year. So we're going to subtract that because we want beginning cash. So I know this is backwards. So if this was on top, we'd have beginning cash of $10.66 plus net increase of the cash of $29 will get us to $10.95. Okay. Now, if it said net decrease in cash for the year, then we would add this, right? Because then we would have a decrease in cash. Okay. All right, and I think that we've beat that one to death. Okay. All right, so now Fink Insurance collected $18,900,000 from its customers during the year. Okay, so don't assume that is all collected from cash. Okay, so is that income for the year, or how much of it was last year that was owed, or how much did they collect in advance for next year. You don't know. You just know that that's the cash on hand, okay? The adjusted balance of the deferred premiums revenue increased from $5 million to $9.6 million during the year. What was Fink's revenue from the insurance premiums, okay? So we're going to take beginning premiums of $5 million, add the premiums that we collected of $18.9 million, and then subtracted our ending premiums of $9.6 million, giving us total revenue of $14.3 million. Make sense? All right. So some of this is premiums collected from last year, and maybe some of this is premiums for next year. So therefore, it's not pure income. Okay. All right. Land was acquired in 2018 for a future building site that cost $41,700. The asset valuation for tax purposes $27,500. A qualified appraiser placed the value at $49,000. A recent firm offered the land for cash payment of $45,000. The land should be reported on the financial statement at, and this is getting to the historical cost. So we paid $41,700, so that is what we are going to put it on the books for. So it doesn't matter what everybody else thinks, that's what we actually paid for. And based on the historical cost principle, we are booking it at $41,700. All right, Mama's Pizza Shop borrowed $9,200 at 9% on May 1st in year 1, with a principal and interest due on October 31st, year 2. Okay. The company's fiscal year ends on June 30th, so we have May and June to deal with. What's the adjusting interest necessary on June 30th, year 1? Okay. So let's figure out the interest. We have $9,200 times 9%, so total annual interest is $828. And we're going to divide that by 12, so we have monthly interest of $69, okay? And then we have to accrue it for May and June. So 2 times 69 is $138. So we're going to debit interest expense of $138 and credit accounts payable or interest payable of $138. So that one hopefully was pretty straightforward. All right. Let's see. So basically what we started with, the problem gives you, so here's the pre-closing trial balance for Klein Industries. Okay, so this is what we got. Okay, don't just sort of ignore all my highlights. But okay, so our debits and our credits equal, so that's good. $1,916,000, that was good. So our debits and our credits balance, that's always a good thing. Okay, so the question is, assuming no income taxes, compute Klein's total shareholder equity. Okay, so what I'm going to do then is I am going to grab everything. So I'm going to grab assets, and I'm going to grab liabilities, and I'm going to grab equity, and I'm going to prove this 2 different ways. Okay, so most of you do not. Okay, there's this lovely thing called a worksheet. So we started out with the trial balance, and then we put the balance sheet accounts over here, and then we put the income accounts over here. I'll show you another example here in a little bit. Just makes things really easy instead of having to actually prepare the statements. Okay, so what's the shareholders' equity? So we have accounts receivable, an asset. We have cash as an asset. We have equipment as an asset. We have inventory. Okay, so that all totals $1,141,000. And then we have accounts payable as a liability. We have accumulated depreciation in the credit column. We have a notes payable, which is also a liability. Accumulated depreciation is a contra asset that has a credit balance. Okay, so we're going to grab that. So that's why I could have it in the asset be a negative number, but I think that's really confusing. So that's why I'm just going to put it in this column over here. All right, and then sales revenue. So when I add all that up, that gives me $494,000. And when I subtract $1,141,000 from $494, I get $647. Okay. Another way to prove that is I can take my equity accounts, common stock, and retained earnings. That gets me $595, and then when I add my net income, okay, which is $827 minus cost of goods sold, minus depreciation expense, minus interest expense, minus Rent expense minus salary expense gets me to $52,000. And when I take $595 plus $52,000, that gets me to $647. Okay? All right. So hopefully that's helpful. Let's move on. All right. So the employees for Neat Clothes work Monday through Friday. So this is a adjusting entry for payroll. Okay? So they work Monday through Friday. Every other Friday, the company issues payroll checks totaling $41,000. Okay, so every other Friday. So their payroll is a 10-day period. Okay, so we take the $41,000 divided by 10. We're paying $4,100 a day. Okay, the current payroll ends on July 3rd. Neat Clothes is now preparing quarterly financial statements for 3 months on June 30th. What is the adjusting entry to record the accrued salaries as of June 30th, right? Because we don't stop. So if you're paid every other Friday, you do not get a special check on the last day of the month, right? So we are going to accrue that expense, recognize that we owe it, and then pay it next time payroll happens, which is going to be on July 3rd. So we have 3 days of July. So it has to be Wednesday, Thursday, Friday, okay, first, second, third. So therefore we have Monday, Tuesday that are in June. So we've got to get those two even though we're going to pay out in July, we've got to get those 2 days expenses in June. And the way we do that, so we have biweekly payroll of $41,000, and it's a 10-day period, so $4,100. So $4,100 times Monday, Tuesday is $8,200. So debit salary expense for $8,200, credit salaries payable. You only use salaries payable at the end of the month. It is the only time you use it, when the end of the month falls on a day that is not payday. Okay? If the end of the month falls, like if your Friday happens to be on the 30th of June, then you don't have to make this entry. Okay? You only need to make this entry is when the end of the month does not fall on a payday. Okay? All right. So this is the worksheet I'm talking about. Okay? And if you needed, so basically if you started out with this balance sheet, basically this, you're going to see this problem reiteration, the China Tea Company, it's either going to ask you to prepare the balance sheet or the income statement. So I just thought I would just show you how to do it. So you basically, in your Excel spreadsheet, you've got this set up already, and then basically you're just going to bring your balance sheet accounts over, okay? Cash, accounts receivable, prepaid rent, inventory, equipment, and then accumulated depreciation, accounts payable, notes payable, salaries payable, interest payable, common stock, and retained earnings. Okay, we're stopping at revenue. So those are all the balance sheet accounts. And you notice they don't balance down here, but we'll get there in a second. But right now we don't. Okay. So we have debits of $661,300 and credits of $585,600. Okay, I know we're out of balance. Just chill for a second. Hang on. Can you see me? There we go. Sorry. All right. Good. Hopefully you can see me now. See everything. All right. All right. So now then we're going to take everything left. We're going to take the salaries, and then we're going to take cost of goods sold, salary expense, rent expense, depreciation expense, interest expense, advertising expense, and bring this all over to these two columns, debits and credits. So again, we don't balance. Okay, we have credits of $540,000, and we have debits that total $464,300. Okay, the difference is net income. So if we take $75,700, that's $540 minus $464,300 is net income of $75,700. So if we add that to the credit column here, or the equity column over here, that is then going to bring both of them to $661,300, and we balance, and then we have accounting nirvana. So that is how you quickly can do the balance sheet and the income statement based on a trial balance. All right, so Lancet Corporation trial balance included the following. We have accounts payable, bonds payable due 2033. Oh, I didn't help. I was trying to get rid of all the dates, but obviously I didn't do so well here, so I missed this one. We have bonds payable 2033. We have salaries payable. We have notes payable 2025 and notes payable 2027. So what should be included in the current assets section? Okay, so obviously accounts payable. This is a no-brainer. Okay, so what this is testing is, do you understand that the current portion of long-term assets our long-term liabilities needs to be in the current liability section. So that's what this is testing. Okay, so 2033, that's due in 9 years, so that's going to stay in the long-term liabilities. Salaries payable, yes, we're going to pay that next time we pay payroll, so yes, that's a current liability. And the notes payable that are due in 2025, so that's less than a year, so we are putting that in current liabilities, and we are not going to put the 2029 because that's due in 5 years. So we're going to add all that up, and our current liabilities are 64,200. Current liabilities. Ooh, I don't think I spelled that right. All right, we'll figure that later. All right, I think maybe there's too many I's. Okay, the next one is just going to ask you to calculate ratios. So again, get a ratio sheet, right? And type in all the ratios. I forget which chapter it is in your book. I'll try and put that in an announcement. Ratios, right? But set all those up, so all you have to do is drop the numbers in and boom, it'll calculate it for you. Because there are going to be a lot of these, and you do not want to waste your time trying to look up like, oh, what is working capital and what is quick just assets and asset test. And if you've already got it pre-programmed in an Excel spreadsheet, just boom, 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 you're done. And you can just go and make this work. And again, if you don't have two screens, the system may not let you switch back and forth. That may be a problem. So having two screens might be easy, or even if you had a laptop and your PC. I mean, if you just have, or your iPad. To me, Pages is like a nightmare. I'm an Excel girl, so. But anyway, if you had another thing where you could do and have these Excel spreadsheets set up, you're just going to save yourself time. All right. So here we basically have a balance sheet. So we have cash, accounts receivable, notes receivable, inventory, prepaid expenses, total current assets. All right, equipment and total assets. And then on the liability section, we have accounts payable, other current liabilities. So we have total current liabilities of 295, long-term liabilities of 99, total liabilities of 394. Stockholder equity, we have common stock of 131, retained earnings of 307, so total equity is 438, and total liabilities and equity is 832. So the first thing it asks us is working capital. So working capital is current assets minus current liabilities. So current assets is 560 minus current liabilities of 295. Let's highlight that. And so that gives us working capital of 265. If it asks for quick assets, so do not be confused with quick. Make sure you read the question well. I mean, this is where the rubber hits the road for accounting. You have got to pay attention to details. The devil is in the details, and you cannot afford to make a huge financial mistake because you didn't pay attention. So contract issues, federal law requirements, especially if you're in the financial banking business. I mean, there's just all kinds of requirements, right? So make sure you read the details, okay? Pay attention. So what if it asks you for quick assets? Okay, so quick assets is, so let's talk about the quick ratio. So quick ratio is current assets minus inventory and prepaids, okay? So current assets, 360, so 560, minus 42 minus 208, okay? And that's going to give you 310. So you can always also get there by saying add cash, add accounts receivable, add notes payable. It also gets you to 310, okay? So it asks for quick assets, not the quick asset ratio. Really important you understand the difference, okay? But if it does ask you for the quick asset ratio, current assets minus inventory for prepaid is 310 divided by current liabilities. How about current liabilities? A little dyslexic there. 295 gets you 1.05. Okay. All right. What if it asks you debt to equity? So total liabilities divided by total equity. Okay. So that gets you 394 divided by 438. What if it asks for the current ratio, which is current assets divided by current liabilities? So 560 divided by 295 is 1.89. Is that good? Bad? Anything over 1 is good. So even this acid test is very good. They're very liquid. If you did a company like Home Depot that has most of their assets tied up in inventory, you're going to see such a huge gap between the current ratio and the asset test. Like the current ratio may be like 1.5. I'm just pulling these numbers out of my ear, and their asset test ratio might be 0.6 because they've got so much tied up in inventory. All right, and so the asset test ratio is like how liquid are you really? Because inventory is the last thing to be that's going to turn into cash. All right, let's move on. We are coming down to the end of it. Hopefully, you guys are still with me. Hope you got some popcorn when you got started. All right, suppose that Laramie Corporation's adjusted trial balance ignored the following information. What effects, if any, would these have on the stated components of Laramie's year one income? So $12,000 of the paid and recorded rent expense pertains to year two. So maybe we paid, maybe we prepaid for 2 years and we expensed it all in 1 year. So that's could very well happen. Somebody not paying attention. So if that case, the assets are understated because we should have a prepaid of $12,000. So assets are understated. Liabilities have no effect. The equity is understated because we have overstated expenses and understated income. So if we've understated income, we've understated equity. So we've taken $12,000 less got transferred to equity than should have. So how do we fix that? We would go back and credit rent expense and debit prepaid rent. So that's how we would fix that. Okay? All right, we're on the last problem. So basically, this is just a way to show you that the ending balances for year one become the beginning balances for year two, and then how to solve for things that we don't know. It's actually a very simple problem. It looks a little convoluted the way it's laid out, so we're going to lay it out in a better format, and we're going to solve it. It's going to be quick. So basically we have some information for a dental lab for year one and two. So year one, we have retained earnings